Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is the January 29th, 2012 edition of Market Outlook. So let's get into the overall NASDAQ and where we are. We had been talking quite a bit about a decade-long channel and did a little bit of updating. So a couple things to take note. Number one, you can see that we're at the top of a parallel channel, right? And basically closed right at the top of the channel. Now, there's yet another internal channel that started at the mid part of 2010 that also coincides and peaks right at this level here. Also notice that we're at the top or very, very close to a peak out reading in the short-term, or what I would call the 2-period RSI. So the fact that we're at the top of the channel, still at a peak out reading in the RSI, and more importantly, you can see that the volume has dropped off precipitously on this rally up. Let's take a look at the daily chart in the NASDAQ 100, and you can see similar. We went to the very top of the channel, failed on Thursday, closed just under it, and paused. Now, this is sort of what we had been talking about last week. We had also touched the top of the overbought reading in the RSI, but really didn't get much of a sell-off. So it's very possible, and we're going to have to look at the short-term structure of the market, the 2-day and 3-day pattern. But you can see right here that we're sort of holding at a relatively high level without very much of a correction. So the question is, how will the short-term pattern and the tactical implementation play out here? So we're going to let the market guide us, because it's very, very possible with extremely light volume that volume could come in with big portfolio managers and hedge funds not committed to the market, and you can see the upper end of this channel is around 65. So there's a good 7 to almost a 10% move left to the upside of this channel if we clear it. Now, let's take a look at another chart that we had been talking about in the text version of Market Outlook, and that's UNG. So there's a couple of things with UNG that I want to point out. First one is that UNG, natural gas, this is the ETF for natural gas, has been in a severe downtrend. Let's see, it was actually trading at almost 130, or it was trading at 130. It's now down to under 6. So you can see the channel here, the accelerated down channel. Still some more to the downside, but we're also at probably one of the most extreme oversold readings that that we've seen in any stock or financial instrument on a monthly basis on an extreme amount of time. Now, this has happened before in natural gas. There's been tremendous pressure and overproduction in natural gas, a glut of supply, and we have seen these conditions. But this is pretty extreme. Now, what's interesting is that you had big news that Chesapeake Bay has thrown in the towel and is really cutting back on production and connecting up new pipelines of natural gas, and the market has rallied. Let's take a look at the weekly chart here, because something that occurred on the weekly chart that hasn't since the beginning of this massive decline is that you had a huge amount of volume. So this is an indication that the culmination of this huge decline might be over. Look at this volume. Normal volume is 63 million shares in UNG. We topped it by a factor of 3.5 to 1 from its normal volume, and this is a very interesting indication along with that news. Now, interestingly enough, on the daily chart, you can see we also had a very interesting formation here. You had a climax sell-off, an inside day, and a pretty good volume on the breakout right after the all-time lows. And on a weekly basis, the volume continued to follow through. So this definitely bears watching. The type of trading I would do on this would be to try to buy weakness, 30-minute OR reversals, and also buy strength, certainly above the $6 level in UNG. Now, finally, let's take a look at gold. Gold exploded this week on the news that the Fed is going to keep interest rates low. Now, going back historically here, you can see that the monthly chart on gold at the midpoint or the late December tested this long-term monthly trend line. At the same time, we got extremely oversold on the daily chart here on the RSI, and the market has moved up sharply from there, almost $200 an ounce from the lows set at the end of December. Another factor to look at is the fact that the 65-week, the critical weekly moving average, we touched it and bounced off it sharply. So now we are starting to get a little bit overbought, not quite there on the weekly basis on the RSI. Volume has been relatively decent on this rally, so that is fairly convincing. In addition, on the daily chart, let's take a look at this daily chart. You can see we sort of tested this 50-day, this declining 50-day moving average, and tested the 200 at the same time, powered through it. That's pretty convincing action. I can certainly see a potential pause here with a couple more up days and maybe a test of that 50-day moving average or where this market broke out from on this particular day here. But overall, the trend looks very, very much intact. If we draw a trend line from the highs to here, you can see we also broke out of this pattern here. At best, I could see a test of the trend line and the 200 where the 50 all converging around the same point. So you can certainly have a back test here without violating the longer term uptrend in gold. So that's it for this week. Lots of things at interesting points. Obviously, the gold market looks like it's reasserted its longer term trend, very strong, getting a little bit rich, but still some more on the upside, and a potential back test to that 50, the 200-day, and the trend line from the recent highs. And this is a very good, valid trend line as we has a series of lower lows from these highs. So this is excellent trend line theory at work here, right? You got a series of lower lows, lower highs, valid trend line, and a nice breakout from it. So that wraps up this week. Look forward to seeing you next week, and bye for now.